Today on Money Life, a reminder that
There's no place like home.
especially when you've got a really low mortgage at a time when mortgage rates are high, should you expect that there will be no place like home with a low mortgage again? Not so fast.
Will people experience levels of affordability like they had 2-3 years ago anytime soon? The answer to that's no, because that would require significantly lower rates. I'm talking like 2-3 percentage points lower, back to the 3% kind of mark. We don't expect that to happen anytime soon. And so essentially, how it's going to get better is not going to be based upon mortgage rates. They might help on the margin if they get a little bit lower, but really through the income growth outpacing house price appreciation scenario.
That's Mark Fleming. He's chief economist at First American, and we're talking about what's happening with rates and what it's doing to housing affordability around the country. But we'll also talk about commercial real estate and much, much more in a wide-ranging big interview. But up first today, Dan Weiner, the former chairman and chief executive officer at Advisor Investments, the publisher of the Independent Advisor for Vanguard Investors for many, many years. He returns to the show to talk about a piece he just wrote for Barron's on why investors do not need alternative investments, private equity, things along those lines in their retirement plans. He'll share that reasoning with us as we start today's show. Plus, we've got Matt Zajahowski, research analyst at North Star Inbound, talking about a survey for bestmoney.com, which shows that Americans are taking responsibility and blaming themselves for the credit card debt that they've got. Yeah, you shouldn't blame anybody else for it, but are they also doing what they need to take care of it?
Go see, I'm home.
Well, if you consider home to be living the money life with us every day, then yes, you are home. If you're considering home to be where you've got golden handcuffs because you got a mortgage and you can't really afford to replace it, well, then you're also in the right place, because that's what we're going to be talking about today with Mark Fleming. And you will find it very interesting, some of the research, because as much as we talk about golden handcuffs and whether or not it's a real thing, and I think it is to a great extent, he points out that basically for over 40 years now, since mortgage rates were in the 18% range in 1981 when I was in college, mortgage rates have more or less declined. Now, it's not to say that they didn't have pockets where they went up a little bit, but mortgage rates here have gone from 3% not that long ago to 6% today. That's doubling. That's a real significant impact. And that's something that we haven't seen for a while. And it's interesting when he talks about the data that is or is not out there for it. We have that. We got Dan Weiner. Always great to chat with him. He wrote a very thought-provoking piece for Barron's that takes a look at the changes. We've talked about them a couple of times on this show about how they're now making crypto and private equity and private credit and other alternatives something that is more easily put into retirement plans. And we talked about this as well with Adam Bergman from IRA Financial while I was at FinCon. And on the one hand, if you tell me that the state-of-the-art asset allocation would say put a little piece to crypto, which a lot of big firms are doing, et cetera, it's not the worst thing in the world if your life cycle funds go off and add a small allocation there. But I wonder whether A, consumers will know about it, and of course, B, there's that second side that everybody was all up in arms about when President Trump first signed the law that said, people are going to go off and blow up their portfolios. I don't think so. The historic side says that 401k investors tend to be more conservative. It's not to say that there won't be some people that go off and do it and go, hey, it's my 401k and now I can trade crypto in it. Yeah, there will be a few, but they will be the exception, not the rule. The question will be, do you benefit if they add this kind of stuff into your life cycle funds, your default choice for so many investors? So we'll talk about that as well. And then an interesting study out looking at credit card responsibility. Like, I'm glad to see it, because I thought when I heard that they were doing this study, I thought we were going to wind up with a thing that goes, a whole bunch of people blame inflation for why they have more credit card debt. Yeah, you might have more credit card debt because you're paying higher prices, but you are still making the spending choices. So you got to blame yourself for this. You got to take responsibility. If you want me to take responsibility for the stuff I say here, hold my feet to the fire, but also hold me true to the stuff we're doing. Chuck at moneylifeshow.com is how you reach me. Again, we had some people who yesterday were having problems downloading the shows at their at their favorite podcast app. The shows were up, but we appreciate those warnings. So thank you for sending them to us, because we do want to check up on it. We don't know what's going on, where all of a sudden we're having this issue where Monday's show didn't get up really in a timely fashion every place. It was up in most places, but not everybody's. Some of you didn't see it show up in your podcast player till Tuesday morning. Tuesday show, we don't understand what's going on, but we are always looking after it. So please tell us, because you cannot assume we're going to know every place that it's up and working. So let us know. We appreciate those. But anything else you need to tell me, Chuck at moneylifeshow.com. Right now, let's get into it. We'll start things off talking with Dan Weiner when we come back in just a moment.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Welcome to the other interview on today's show. We could have called this off the news, because we're kind of going off the news with somebody who you are familiar with, but you may never have heard him like this before, because joining me now is Dan Weiner. He is the co-founder, former chairman and chief executive officer at Advisor Investments, which is now RWA Wealth Partners. You can learn about them at rwawealth.com. Dan is on the board for RWA Wealth, but he started the independent advisor for Vanguard investors in 1991. And that is probably where he made most of his reputation, even though he was managing money for Advisor Investments as well. He was the primary observer, critic, chief cook, and bottle washer of a publication that tons of people used to be able to help them do better in Vanguard funds. That stopped in 2022, and it became the independent Vanguard advisor, run by Jeffrey DeMasso, who was just on the show like a week ago. But Dan is on the board of directors for the independent Vanguard advisor as well. Again, if you want to learn what he's doing now, rwawealth.com. But you can also find out what he's doing now by looking at a piece he just penned for Barron's, where we have talked about what it means to have so many new types of investments that are now being pushed on retirement plans. You should have private credit. You should have private debt. You should have private equity. You should have crypto and all these other sorts of things. And Dan wrote a piece for Barron's that's called, "I Learned the Hard Way, Private Investments Probably Don't Belong in Your Portfolio." We have that linked up on the Money Life guest page. We're going to talk about it now. Dan Weiner, it's great to have you back on Money Life.
It's great to be here, Chuck. And I got to say, if there's any person who knows how to ask the questions about these things that are being promoted so heavily on Wall Street right now, it's you. I mean, this is the topic du jour, I think. And you've got a lot of people on Wall Street who are wringing their hands in glee, just hoping they can get a piece of the action when alternatives get shoved into people's retirement accounts.
Well, but part of the reason I want to talk to you is because I want to talk about how it's going to be shoved in, because so much of the headlines around this have been on, individual investors will blow themselves up putting crypto into their portfolio. And that worries me a lot less than the companies that are running life cycle funds are going to go, what's a life cycle fund without a little private credit? What's a life cycle fund without a little crypto? And the guy who would never get this stuff is going to wind it. So obviously from the there you goes, you believe that's what's coming here.
Yeah, I do. And I think it's going to come in the form of agglomerations of, you're going to hear that your target date fund, your retirement account, whatever, has a quote unquote sleeve devoted to alternatives. When you get your statement from your company, what have you, it's going to say alternatives. You, Chuck, you, Dan, you've got 18% of your portfolio in alternatives. And it's going to be harder and harder. It's going to get harder and harder to find out what those things are and what the fees are that you're paying for them, who's managing them, and how they're doing. It's going to be this big ball of mess that you're not going to be able to understand. You're going to keep being told, hey, this is really good for you. This is really good diversification. This is going to improve your outcomes and it's going to lower your risk. This is what we're hearing all the time now from the promoters of these things. And it's simply not true. I mean, the data is so bad. And let's just take it right back. I gave this example in the piece I penned for Barron's. Yale University, their endowment was the leader in using alternatives. David Swenson, the late David Swenson, was the guy who said, hey, we should put some of this endowment money into venture capital. We should put some of this this endowment money into private equity. And he got into these quote unquote alternatives back when they weren't so popular with pension funds and university endowments. And he was able to cherry pick some of the best managers in the business. Well, guess what? Yale University is trying to get rid of a whole lot of their alternative investments right now. Not because David Swenson died, he died many years ago, because they see that these things are not performing so well now, that maybe the market has reached a top for these things. There's a lot of money chasing a lot of companies. This argument that the public markets are shrinking because there are fewer and fewer public companies. Hello, I think there's still 4,000 or so out there. I think you ought to be able to make a pretty good choice among the public companies. Yes, there are private companies that are very exciting, doing exciting things and are going to do well. And I've been fortunate to be invested in some of them. But my experience with alternatives and with privates is that it is a big black box. And I do not think it's appropriate for the common investor. I think that the data that's being promoted out there is rife with problems. And I just think it's the wrong thing to be shoving down someone's retirement account.
Let's give a little bit of your experience because, as it said, and just the headline is, I learned the hard way. So explain the hard way, because you can't be a long-term investor without having some things come to you the hard way. But a market crash is not the hard way. A blunder is the hard way.
Yeah, I mean, I've been doing this for a long time, and I have devoted a piece of my portfolio to this, and certainly not the majority of it, let me tell you, because that would be a big mistake. But, there was someone I met through a very good friend who had all the credentials, opening up essentially a venture fund that was going to do alternative energy and, the digital companies looking into alternatives and into energy conservation and what have you. Sounds great. The problem is you start investing in these companies and then the market either walks away from them or government policy changes or, all of a sudden companies are not as eager to spend the money on these technologies as you initially expected. And so, you don't get a return on your money. Sometimes you don't even get a return of your money. Private debt. I've been in a bunch of private debt funds that all promoted incredible potential. And I'm not doing this alone. I mean, I'm doing the research here with my closest friend who is, was once one of the most prominent venture capitalists in Silicon Valley. And he and I have done a lot of investing together. We've done these things and some of them work out great, but a lot of them do not. And you go back, it's always very instructive to go back and look at the promotional and marketing and materials and the letters that we got when we were first looking at these various investments, and then looking at what your results are. And you say, boy, didn't come close. Really didn't come close. I'm fortunate enough to be able to take that like a big boy, but I think there are a lot of people for whom putting these kind of investments into a retirement account is close to criminal.
That said, it's going to take something for it to turn out that way, from the standpoint that if the allocations are kept reasonable and you have a 15 to 20% allocation to alternatives, and they don't all break at the same time, and you have diversification, I don't know that having 2 or 3% in a Bitcoin fund is necessary for a retirement plan, but I also don't know that 2 or 3% would blow up a target date fund. I mean, am I wrong here that, if we wind up having a blow up in private equity, but it's only 3% of your portfolio, that'll stink for you, but you're still probably on target with your target date. So are you forecasting that somebody's going to wind up waking up one morning and going, yeah, my target date was 40% alternatives and I'm broke?
I think what it is in doing this, you're trying to fix something that isn't broken already. I just don't see that it adds a lot of value, if any at all. And I think that the way this is being promoted, that this reduces risk. It only reduces risk because you don't get to see how prices fluctuate on a day-to-day basis. Privates tend to value themselves at best once a quarter. Sometimes I've been in privates where I got a valuation once a year, if that. And so I don't buy this lower risk comment from the promoters. And there is really very little evidence that the performance is going to outperform. Take a look at the benchmarks that are often used to compare how these alternative investments do. The benchmarks are not the S&P 500, which is what you and I probably benchmark the bulk of our portfolios against, and most of your listeners probably do as well. It tends to be some amalgamation of a global bond and a global stock fund, and it makes the performance look a heck of a lot better if you're not comparing to an S&P 500. I just don't think this adds value. I think it adds complexity. I think it adds opacity. I think that there's going to be a liquidity issue here, depending on how well or poorly these alternative sleeves are run. I just don't see that it's necessary. And you're right. A 2 to 3% position in Bitcoin doesn't harm you too much. It probably also isn't going to move the needle very much. So why complicate it? When you were talking about experts in the field here, the one that I keep thinking of is someone you know very well named Jack Bogle, the late Jack Bogle. If he knew this was happening today, I swear he would be tearing what little hair he had left out of his head.
I think he would be, but at the same time, indexing, as much as he loved it, now you have personal indexes, right? People make their own individual index funds. That was not what he envisioned either. So given that, should we get to a spot where we wind up saying, okay, here's a firm that's giving you not one, but 2 choices for your life cycle or your target date fund in a retirement plan. One is, 2055 conventional, like it's no alternatives. And the other is 2055 with alternatives. Like, should we have that and have some basis where somebody can say, okay, I want this or I don't want this in my portfolio at the macro level of a portfolio since they're using a target date?
Let me throw a question at you. Do you think that most investors, retirement savers in target date funds know what they own or could answer the question properly? Should I have this or should I have that? Should I take the target date fund that's a standard or should I take the one with the alternatives? Because boy, the guys who are promoting the ones with the alternatives really are making it sound pretty sexy to me.
Well, but in a document, in a welcome to your 401k plan, here's your target date funds. If you said conventional, it includes large cap stocks, small cap stocks, bonds, et cetera, in a glide path designed for this year. And the other one says it includes large cap stocks, small cap stocks, private credit, private equity, and cryptocurrency. Well, while I worry that someone go, okay, hey, I want to get the crypto in there or whatever, the fact is at least they know they're consciously making that choice. Because my worry with this is not about the person who's going to go out and go, oh, I can get crypto in my retirement plan. If they want to do that and they do that directly themselves, they have nobody but themselves to blame. My worry is the person who it just happens one day. They get some notice that says your portfolio's changed, and they don't recognize that the money manager has changed the portfolios to put this stuff in.
Right. So let's remember that back in let's call them the bad old days, When you enrolled in your company's 401k plan, your money sat in cash until you made a decision, right? And so a lot of people, unfortunately, didn't see their retirement accounts grow very much until they took charge or someone poked them and said, hey, you know what? You're not doing the right thing here. That changed. Now, when you enroll in a 401k plan, you are automatically enrolled in a target date fund, which is geared really to your age. There's nothing else to it, which to me is problematic if you know something about investing. But if you don't, it's a great decision being made for you, done. I think if someone wants to offer an alternative target date with alternatives in it, let it be sitting there as an option for you, but don't make it the de facto investment when someone enrolls in the plan. Like you said, make the participant make the choice.
From our mouths, hopefully to regulatory ears, although I doubt that's going to happen. But Dan, I appreciate the perspective because I think not enough has been said to say, hey, it's, this is where the danger lies in this thing. And thank you for taking the time to talk to me about it on the show.
The whole thing that prompted my article at Barron's was that I felt there were hundreds of people promoting this who had no experience with it. I mean, you and I've talked about this many, many times in the past. There is so much talk of investing by people who don't actually do it or promote a particular, well, this is the old Wall Street broker thing, right? You got to buy this hot stock today. Well, Mr. Broker, do you own it in your account? Hell, I wouldn't touch that with a 10-foot pole. I just think that there are very few people promoting these things as necessary in your retirement account who have experience with them. And if they don't have experience with them, how can they be promoting them to retirement savers? It just doesn't work for me.
They're hoping that it's going to be like a doctor who, of course, is prescribing you a medicine that they don't take because they don't have that problem or what have you. And the same sort of thing. Oh, do you want this medicine? How do you build your portfolio? I build it in a way that makes sense for me. That's how they get away with it. Dan, great stuff. Thanks for joining me on the show.
That's how they get away with it. All right, man. Great to talk to you.
Dan Weiner is the former chairman and chief executive officer at Advisor Investments. It's now RWA Wealth. He's on the board, rwawealth.com. We have a link directly to his piece in Barron's. You should check that out as well. And we are just getting started on the September 24th edition of Money Life. Later, the big interview with Mark Fleming. We'll be talking the economy and more. Stick around.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Now let's take a look at what the survey said. This is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at a study that digs in on the psychology of credit card debt, where thankfully, I think, and rightly, more than 3/4 of Americans blame themselves for their credit card debt. The study was done for bestmoney.com, and here to discuss it, Matt Zachahowski. He is a research analyst at North Star Inbound. They did the research for them, so it's bestmoney.com. But if you find Matt on the Money Life guest page or where we mention him in today's show notes, you will find the direct link to the psychology of credit card debt study that we're talking about. Matt Zachahowski, thanks so much for coming back to Money Life.
Hey, always a pleasure, Chuck.
I don't think we should be surprised, except for the fact that Americans are pretty good at shifting the blame. Those folks with credit card debt are at least thankfully looking in the mirror and saying, I made bad choices. So that begs two questions. One is when they look in the mirror and say, yeah, I made bad choices, that's why I have credit card debt. Are they making better choices now, or are they continuing to make those bad choices? And what are they doing to try to fix this?
I think that's a really powerful question. And, I was taken back by, honestly, just the brutal honesty in this scene. So many people being able to look at themselves and say, like, yes, there are factors like inflation and higher prices, but ultimately you're the person swiping the credit card. So there is this moment of self-reflection. But I do think that, the surveys kind of revealed that, yes, even while people are aware that they're doing it, they're still making these decisions that is fueling, rising credit card balances and how much they're going to have to ultimately be responsible for paying. So while they're aware of it, they're still, shifting into these habits that can be really easy to do and lead to these high balances that, a lot of people are dealing with.
A lot of this had to do with splurging. And there is some other research that talked about how people splurge. It said they're making small little $5 here and $5 there gives me a feeling of control. But your research would suggest that if you spend on average like $1 or $2 a day, you're actually building this thing up and making it a lot worse on yourself because that's where people are going. Or was this the people who got into credit card debt were doing it because they were not making the little splurge, but the big one?
I think that there was a mix of both. Like you said, I've seen similar findings that said that, like, hey, these everyday purchases, like, going out to lunch or, maybe buying something extra at the grocery store that you didn't plan to, these little splurges that we're doing do add up. And we certainly did see that in our survey as well, too. But there also was this element of larger purchases as well that people are saying, hey, this was not something I needed to purchase, but I wanted to purchase. So maybe it's like a new TV that, like, hey, the one I have is good, but the new one at the store is all shiny and nice, and football season's coming up, and hey, I don't need it, but it's nice, so I'm going to do it. So definitely an interesting combination of small purchase and big purchases adding to this snowballing debt issue.
What are people doing to take care of this? Plenty of people carry credit card debt basically ad infinitum. They just keep going forever. So what are folks doing to try to take care of this?
Yeah, I mean, I think the smallest step that people can do to do it is one of the simplest ones, and that's budgeting. We did find in our survey that said that over 50% of people say they either don't have a budget in place or they can't stick to it. And that's a huge recipe for debt, right? Even something small that is, focused on budgeting around the essentials, savings, even some fun money could help people start to keep their spending in check. So I think that's one of the simple things that while there's this large percentage who aren't doing it, nearly 50% are doing it as well and taking the simple step to, hey, let's kind of just plan our purchases out, budget a little bit, and these small little steps we can take can start to help you chip away on those bigger balances.
You talked about the brutal honesty of this. Does that suggest that the folks who didn't own up to it are fooling themselves, or does it suggest that they have actual circumstances?
I think it's a mix of both. I think there are people, like you said, who just operate on this infinite level of, hey, I have credit card debt and I can get more credit cards and it can keep building it in itself. So I think that there is an element to people are fooling themselves to an extent, and then others that are taking it a little bit more seriously and saying, hey, I know I have issues. This isn't something that's going to go away, but there are small things that we can do to help, chip it away and have better financial discipline moving forward.
I did notice that a lot of the research talked about unplanned purchases, whether it was comfort purchases at the end of a stressful week or things along those lines. Did several people say, no, I have a plan for my debt? Like, what percentage of people go, okay, I took this on because I couldn't spend the cash on it all right now, but my debt is fully under control?
Yeah, there's definitely those people that say, hey, I've got a plan for it. I'm going to pay it off and do that. It wasn't anything noteworthy in the survey, but I do anticipate that, again, there are people who know that they can take a debt on, they can pay it off and set a plan for it, whether it's just sticking to plan that you're approved for. So say like an auto loan or something for that. We're saying, hey, there's going to be no interest for a year and I know I can make all the purchasing off like they planned. So I do think that there is a percentage of people in the survey that are making those, responsible decisions and taking care of their debt as they intend to.
As much as I'm critical of folks, there's a big chunk of people who, in this case, were not only taking responsibility for their debt, but when they had to suss it out, were saying, No, my debt's there because I had to make certain large purchases, whether I wanted to make them or not. There is that side that says, I made the purchase, I understood what I was doing, but I felt I had to do it.
Yeah, absolutely. And I think, there's a ton of common factors where we see that, whether it's your car breaking down unexpectedly or, a trip to the doctor or the vet. They're unexpected, but, we can make a plan to deal with that and not have it impact going much further into debt beyond, when you're going to pay it off.
It's a really interesting study. It's out from bestmoney.com. Matt, thanks so much for joining me to talk about it.
Always a pleasure, Chuck.
That's Matt Zajahowski. He is an analyst at North Star Inbound, research analyst for North Star Inbound. They did the research for bestmoney.com. Find Matt where we mention him, and you will find a direct link to the study we've been talking about. And you are responsible for your debts. You're also responsible for taking charge of living your money life. You can take charge right now by sticking through this break, because we'll be back with more talk in a moment.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Welcome back to Money Life, where it's time for the big interview on the September 24th show. Joining me now, Mark Fleming. He is chief economist at First American Financial Corp. And if you want to learn more, well, firstam.com is the website. We have a direct link, however, that will get you to the Reconomy podcast, which features Mark and Odetta Kushi, who is their deputy chief economist. Both Mark and Odetta have been on the show many times. It's a bi-weekly podcast on sort of all things real estate and real estate markets and more. Again, you can find that too at firstam.com. Mark Fleming, welcome back to Money Life. It's been a while.
Yeah, thanks for having me.
Let's start with what is going on with the housing market and the housing economy, because we keep sort of hearing one thing, but then you talk to people and they say they're experiencing something else. So give us the base case for where things stand right now.
So remind me, since last we talked, was it almost a year or 6 months ago?
I want to say it's a year, but
I want to say it was almost a year ago. But since last we talked, much has happened, yet in a weird way, maybe much has stayed the same. And so what I mean by that, obviously, is we have not experienced a rate reduction from the Fed for the entire year in 2025 until just very, very recently, where we finally got our first September 25 basis point rate cut on behalf of the Federal Reserve. So what stayed the same is mortgage rates were largely in the mid sixes for most of this year. But while that was happening, we've seen increased levels of inventory, more new listings, more active inventory. And let me be clear, more than a very low amount, not back to anywhere close to normal levels, but more is better than less in the housing market. And that has caused house price appreciation to cool down very dramatically in many markets, which has basically given people a modest boost in affordability relative to a year ago.
by the way, a year ago is virtually exactly when we did our last.
Oh, you're okay. Perfect.
Basically it's like a year and 3 days, 4 days. The fact is that there are plenty of consumers who are talking about unaffordability. Much of the focus has been on interest rates, but some of the focus should be on housing stock and the rest. So now that we've got the rate cut cycle starting and we have an anticipation of more rate cuts, even though those rate cuts will not necessarily lower mortgage rates.
Right. Big important point there.
Do we have the makings of what we need to make the housing market better?
Sure. I mean, I guess better is a somewhat subjective term. Better than last year. Will people experience levels of affordability like they had 2-3 years ago anytime soon? The answer to that's no, because that would require significantly lower rates. I'm talking like 2-3 percentage points lower, back to the 3% kind of mark. We don't expect that to happen anytime soon. And so essentially, how it's going to get better is not going to be based upon mortgage rates. They might help on the margin if they get a little bit lower, but really through the income growth outpacing house price appreciation scenario. That's how we regain what was lost. The challenge is that that just moves much more slowly over time. We've seen that in the last year. We expect that to continue into next year. That could obviously be even further improved by more construction, more home building, more housing stock, which would continue to keep the appreciation of the asset that's a rare good right now under check.
A lot of people talk about a golden handcuff situation. You've got this great mortgage that you got a couple of years ago. You can't replace it. And you can't, even though housing affordability has not, gotten dramatically worse, you can't really afford to move to the next house and get a better deal. How long historically does that impact the market? Because there does come a point where golden handcuffs be damned. I'm either ready to downsize or I'm ready to upsize or I got to make a move one way or another. So how long does that historically tend to be an issue, not just for consumers, obviously, but maybe more for the economy?
We don't know. And the reason we don't know, Chuck, is because we have not experienced this scenario in the housing market really since we've even been collecting the data, right? 1981, mortgage rates were 18.1%. So for the last 40 years up until 2020, almost half a century, what were mortgage rates generally doing? Always going down. So yeah, great question. Question we asked ourselves between Odette and myself. We started looking back in the data. It's like we don't have any historical experience with the degree of rate lock-in that we have today. So it's really hard to tell. That being said, maybe a more qualitative answer is in order. And that is, well, okay, look, what causes people to move other than what we experienced over the last 40 years was the incentive as rates came down, right? The rate, it's almost like the rate lockout. You are encouraged to move or refinance as rates were coming down. Set that aside. What are the things cause people to move? Getting married, having children, change of job, unfortunate things like divorce create transactions, right? And ultimately aging out of your home. Those sort of life event scenarios largely, I think, are happening at the same pace they always have, right? I don't think that there's big changes in maybe the timing of marriage and having children is happening later by generation, but I don't think it's necessarily happening less. The one thing that is currently happening less than maybe historically is sort of the liquidity of the labor market, people moving for jobs, right? You've heard the term, the no fire, no hire job market you're in. So maybe that aspect is lower, but the life event scenario that's always been there is still there. And that's ultimately going to drive things, but it's really hard to know. I mean, you can barely see the rate lock-in effect slowly going away, but you're talking like a decade kind of at the life event pace of things, if you will.
Well, the life event pace of things tends to be slow, but it'll
Yes.
be interesting because you will get a spot where there will be a generation of people who maybe have felt that they've been locked up, but they're at that spot where they want to move. We'll see if it winds up what it creates, because you could see it creating a boom coming out of it. Do you think there might be a sweet spot where, okay, if we see rates fall a little bit, maybe each step is incremental, but once we get that we've taken 100 basis points or 150 basis points, there it is, the floodgates open?
It's the combination of time and the severity of the rate lock-in effect. So yes, if rates come down a little bit more, maybe we get below 6% next year sometime, right? Then it's like, the rate lock-in effect isn't as bad as it was, or the penalty for moving is a little bit lower now. Oh, and by the way, I've lived in this house now for 6 or 7 years. And so you kind of are getting tired of it. People do amazingly irrational things, like choose to move anyway, right? I think there's a time component to that. It's like the further away you get from when you got that 3% mortgage, the less you worry about that as the reason not to move, and the more these other life eventy kinds of things start to build in your desire. I make the joke, the open house shows up across the street. And everybody does it. Oh, I'm not in the market, but I'm going over on Sunday to check out that house, right? Everybody does this. And then your partner says, "Oh my God, I absolutely adore that kitchen." There is actually
Yep.
a rational decision to be made here.
Yeah. Oh,
Right?
I will tell you that, my wife and I got remarried a year and a half ago, and my wife and I are trying to figure out what the next move might be. And while we expect it's going to be staying in this house, we just had a neighbor sell a house. And the next thing that happens is we're getting, a note from a real estate agent or two who's not in our area who goes, "We had people who like basically looked at your neighbor's house who love your neighborhood. Have you got a number in mind?"
Yeah.
On the one hand, I don't. But on the other hand, I know I could make one big enough that would have me go, "Oh, hell yes,
Yeah.
I would sell."
Yeah.
Right. That would also then allow me to go, and I don't mind giving up the golden handcuffs. Like there's the incentive as well to do that. So you could see
Now
that.
you live in the Northeast, right?
I do.
So it's interesting because that dynamic of tight markets, low inventory, or relatively low inventory and still significant price appreciation is happening in the Northeast and the Midwest, as opposed to if you lived in North Carolina or South Carolina or Arizona or Texas right now, or Florida, especially right now, you would not have that bargaining power that you just referenced as a seller. You wouldn't.
Well, and my children live in the Raleigh, North Carolina area, and it is, of course, very potentially for us a place we might be moving to if we said, "Oh, we
There
want
you
to find
go.
a
Well,
retirement."
now you're going to arbitrage geographically. That's the perfect
Exactly.
idea.
That's
Yeah, yeah.
that's it. We're getting into hold it, sell this one, buy that one, and do the right thing. Although then you might find yourself stuck in that house down the line. Who knows? We'll see how.
See, this all makes the point, right? That we make these decisions to buy and sell. Refinancing are purely financial decisions, but we make these other decisions for lots of complex reasons that have nothing to do with the price of a mortgage.
Well, that also is why most people, as I always say, my house is a use asset. I don't really factor it in. I mean, I know in the end that if I was to say, "Oh, I need to do my net worth today," I would factor my house in at the end.
Right.
But it's the last thing I look at because I'm not considering it a liquid asset. I'm not considering whatever else it might be. It's a use asset.
Yeah, exactly. So this is all why essentially we're forecasting very, very slow and modest growth in the pace of existing home sales over time. Because even if rates came down to say 6% by the end of the year, and there's, like you said at the top of the conversation, just because the Fed's cutting, there's no guarantee that we get necessarily lower mortgage rates. So because of that, we're looking at the housing market as being a much more demographic and lifestyle driven market going forward than a rate driven market going forward. And that's different than what we've historically experienced for the last 45 years.
Let's talk about commercial at this point, because I led with housing because that's the story that most people feel. But commercial has been sort of in a world of turmoil basically since the pandemic. Because, how many people are going back to work? What are they doing, et cetera? How much has that recovered, or have we gotten into what would be considered the new normal? How much are we still adjusting? Because I still see lots of people who they're not real anxious to go back to their office, and their workplace is not necessarily all that anxious to have a lot of space to have them in their office.
Right. So commercial, it's dangerous to lump all different commercial types together. You make the point that all of them sort of took their lumps and have stabilized, but all sort of for different reasons, right? Multifamily, it's around household formation demand and the supply, or the big absorption of multifamily that's happened in the last couple of years. Office, as you mentioned, there's the dynamic of working from home or working in the office. That's still playing out. Retail is more about, how strongly or confident we feel about our economic situation and consumption. So it depends on the market. One thing also that's why they've stabilized, but one thing that is definitely true is as the shorter end of the yield curve goes down with the Fed lowering rates, that does more directly affect commercial lending rates, right? There's no 30-year fixed rate mortgage in commercial lending. That's partly why there was such a big price correction, because there's no such thing as the rate lock-in effect on the commercial side, right? Like that loan comes due, and it rolls over, and you got to do something about it at whatever the prevailing rates are at the time. That's why all those corrections happened. The good news, of course, is they take their lumps much faster in this environment, and sort of they've normalized this idea of 6 or 7% cap rate is a perfectly normal cap rate, and that's good. And any reduction in rates does drive bottom line, does increase transactional activity, improves financing situations. So it's much more sort of liquid or affected by what the Fed does. That's good. And looking forward, each market's a little bit different. I think interestingly, the industrial markets and the multifamily markets, they've had such a boom of construction and sort of supply being brought online in both of those two sectors that right now they're actually struggling in many markets because of essentially a mismatch between the amount of supply coming on and the amount of demand. It's sort of the absorption rate. Like they're having a hard time absorbing all the multifamily units or absorbing the millions upon millions of square feet of industrial space that have been built in some markets. It kind of reminds me of the volatility in Texas. You miss the mark. Commercial real estate is like, oh, we got to build a bunch, and then the demand disappears, and you miss the mark because it takes a while, right? It's really challenging to align the delivery of supply with the demand, and they miss it sometimes.
Well, it certainly is going to be interesting to watch how that plays out. I want to use the time that we have left to talk with you about something you do at First American that also can help us talk about data collection and sort of your feeling as an economist. At First American, you have what you call the First American Real House Price Index, where in presenting it to the public, you kind of point out the price of a home today is not directly comparable to the price of that house 30 years ago because of a variety of factors. So, one, as you look at that, we have a lot of talk in this time about the quality of data, what needs to be updated, how it needs to be changed. So if you make that statement about housing prices based on inflation, does that also hold, like, do you not like some of the data and the data collection we're seeing about the economy broadly, whether it is consumer prices and inflation or some of the other things? How much do we need to overhaul our data? How much do we rely on our data?
Well, in the housing and mortgage market, we have the luxury of extremely transparent and highly available amounts of data, right? The public record is readily accessible, collected by multiple companies and aggregated into big databases, easily available. We've got multiple people or companies that produce models that predict the values of homes. We get mortgage rate data from Freddie Mac like every week. We get daily updates from other sources. So the real estate market has a plethora of what I believe is extremely reliable and available data. So that's good. By contrast, to measure, and so we can measure the real estate market very, very well with all of this data that we have. By contrast, the economy writ large is extremely complicated and difficult to measure, right? And so, yes, most of the data that is collected by the government is survey-based, and survey response rates are down and delayed, and that causes the volatility of the sort of revision histories and things like that. But I don't see any viable alternatives to what would be a better way to collect data on such a complex system as something like a labor market, right? That's so diverse and so disaggregated across all of the country, or prices for measuring inflation all over the country for all these different goods and services. And so there's a lot that goes into trying to do the best you can to measure a very complex system. And I would just remind everybody that we rarely focus on the confidence intervals that all of these statistical agencies report along with the headline numbers, because it's really difficult to talk about the confidence interval on the labor market number when you're in a 30-second spot on CNBC, right? But the confidence intervals are pretty darn big and always have been. So the truth is we try to measure, but there's sort of the statistical honesty of like, it's not that accurate to begin with. We're not quite sure exactly where it lands in these pretty big confidence intervals.
At the same time, you're an economist. We kind of have to trust the numbers until we are more than a little confident that something better exists. Because
what is my alternative for many of these things?
Well, and how much do you worry that if you change the methodology, you compromise everything that came in the past?
Exactly. And there's the challenges of if you look at, again, it's so complicated. There are alternatives to many of these measures, but they have their own weaknesses and flaws. So it's like, well, 6 of one, half dozen of another, right? Again, it gets back to, it's really challenging. Imagine the economy is essentially made up of 350 million people, roughly 130,000 residential households making economic decisions multiple times a day, every day, sometimes rationally, sometimes irrationally. Or actually said another way, most of the time irrationally, right? And how do you measure that? That's really challenging.
Last question here, because we were talking about the real house price index. While everybody loves a hot real estate market and what they think about as a hot real estate market, housing appreciation historically, nationally, has been pretty consistent for decades, if not eons.
Mm-hmm.
That you can look at the numbers. And of course, it's the thing that you hold on the longest, which gives you the longest amount of time for compounding, et cetera. And in any given time, yes, you could have here's a blip. I could have sold my house here for a lot more. But I've always sort of considered my house to be appreciating at about 3.5% a year.
Mm-hmm.
Is that about right? Is that still about right in this country?
That's about right. And, if you hold it long enough, even the global financial crisis, when writ large house prices were declining practically everywhere, if you held through that into the past decade and into now the pandemic, you would have regained and made much, much more on that cycle. So yes, it's a long-term asset hold, which, by the way, you get the benefit of shelter from every single day while you own that asset. That's important, right? But you can't get shelter from a Google stock, but you can get shelter from your home. And in the long run, it always pays off. Additionally, I love to talk about the idea of, if you buy your first home, for example, with 5% down, what's your leverage ratio? Because, by the way, if you put 5% down on a proverbial $100,000 home, 5,000 in, the house goes up by 5%. It's $105,000 now. You've doubled your money. This is 20-to-1 leverage. And all that the other guy, AKA the lender, asks of you is not a 95% stake in the asset and the shared growth that it might incur, but just pay me an interest rate for this money. And so the combination of, in the long run, always growing house prices, and the fact that it's huge amounts of leverage that an individual household or consumer can create, that's why it's such a strong wealth builder over time.
Okay, so I got to add an extra question and extend us one more, because I've had two guests on recently where I'm curious for kind of your take. And obviously, I don't expect you to have heard the interviews. One was someone who was basically saying, at this point in this country, the case for renting for most people is stronger than the case for buying, at least if they are reinvesting their money in other ways. And the other was Paula Pant from Afford Anything, who was talking about housing affordability and basically said, look, if you're a gazillionaire in New York City, the ratios don't make sense for you to be buying. You're better off renting. But if you are an average person with money in Indianapolis, you should be buying a home. I will assume, given what you do for a living, that you are opposed to the you're better off renting than buying agreement. Although, do you agree that it depends on the market?
I completely agree with it depends on the market. I was about to say, your second example, yeah, it might be quite possible that, especially if you have all this money already, that maybe it's better to rent in New York than otherwise, but that doesn't apply, I suspect, to the vast majority of markets in this country. It is true that at the moment, if you compare what it would cost in terms of your mortgage payment, principal and interest, homeowners insurance, and things like that, simply to rent, then in many markets, it's cheaper to rent. You can rent more home than it costs you monthly. But as soon as you start to factor in that you're the one who may be gaining the appreciation benefit over time, that usually tips the scale. And so it really gets down to, if you assume that the house will not go up in value over your holding period, then yes, maybe right now it's better to rent. But is that a wise assumption?
Well, as we said, it may go up that average 3.5%
Right.
over time, but that still is appreciation in the right direction.
If we need to sway your audience any further, let me just point out, housing, there's not enough of it. You can't outsource it, and everybody needs it.
Yep. That's why they teach it in economics class, but it doesn't mean it's easy to understand. That's why we turn for you to help us out. Mark, thanks for coming back to the show. I hope it's not a year before we do this again.
Absolutely. My pleasure.
That's Mark Fleming. He is the chief economist at First American Financial Corp. firstam.com. You can go to their website as well to find the Reconomy, R-E for real estate, Reconomy podcast every 2 weeks with Mark, Odetta Kushi, and me.
Hi everybody, it's Rob Floyd, Money Life's executive producer, and this week we have a contest for Jillian Johnrood's book, Retire Often, which was featured on the September 10th show, right before Chuck headed to FinCon. The book is all about how people can take short or mid-range retirements to pursue their passions and recharge their batteries and change their lives. In the same way that it's never a bad choice to take a break, there are no wrong answers to the contest this week, because all you need to do to enter is send us your 2 most appealing mini retirement ideas. Now, Chuck says you're not allowed to say, "I'd quit my job and do nothing." We're looking for what you would do if you could retire the way Johnrood suggests, taking a break for a month or a year to try something new, pick up a new skill, pursue a passion, and so on. Send your most interesting retirement ideas to chuck@moneylifeshow.com. And so long as you have 2 ideas for your next retirement, you'll be entered in a drawing to win the books. The deadline is Saturday, September 27th at noon Eastern Time. Please put the word contest in the subject line of your entry, and maybe your next retirement can start with reading the book you win.
We're back to wrap this one up. I hope you enjoyed it. I hope you kind of caught the difference between Dan Weiner and what he was saying about individual investors and what we heard from Adam Bergman from IRA Financial during FinCon. Now, of course, Adam Bergman is hoping that people put more alternatives in their retirement plans. That is a part of his business. And he also can talk to the fact that people do it responsibly because they do it responsibly with his company. Dan's perspective, a pretty interesting one, because you will eventually get some sort of a notice, I believe, if you own life cycle funds that says, hey, we've made a portfolio change. Here's a notice, an update about your portfolio. You probably won't have to vote on it. It won't be anything where you got a proxy vote because they try not to do that. They pretty much build their proxy so they can get this stuff in there. And then it will be like, oh, does my retirement plan now have these allocations? And how good or bad are they for me? I think Dan's point, we know they're good for the industry. We're not 100% sure how good they are or how bad they are for the consumer. Again, it's a very different picture when you say they're adding a 2% allocation than when you have an individual going, oh, I can go buy crypto in my retirement plan. Let me go put 80% of my assets or something like that into crypto. We will be watching how it plays out for sure. Tomorrow on this show, Nate Tuft is going to be here. He's Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. They have been overweight equities like this whole year, and I want to find out where they are now. That's one of the things I'm going to be asking him. Also, of course, it's Thursday, so we will have Todd Rosenbluth with the ETF of the week. I believe we're going to be talking about a new bank rate study that's coming out tomorrow. So I think Mark Hamrick will be joining us for that and more. So plan to be here because whatever we're going to be doing, it'll be more fun. If you are looking for something to celebrate, today is National Punctuation Day. Now, I'm one of those people, I want to use good punctuation every day, but when I think of punctuation, I go back to that Victor Borge comedy routine. Victor Borge, one of my father's favorite comedians, one of mine. If you've never seen, or if you haven't seen it for a while, his Victor Borge and punctuation, go watch one of those routines. It's also National Bluebird of Happiness Day, which just reminds me of a Johnny Carson curse when he was Karnak the Great, like, may the bluebird of happiness fly up your nose in reverse. I don't really know why I remember that as a kid, because I was pretty young when I think I heard it. I think that's the one I heard. There were a bunch of bluebird of happiness things. It is also Kiss Day, but that, again, for me, every day, but I will celebrate it with Gail. It is National Women's Health and Fitness Day, and on the food front, National Cherries Jubilee Day. I could make them with that cherry bounce. We made some cherry bounce that we had to sit. It's brandy with cherries, and well, wow, it's now drinkable. It's now done enough time, and wow, is it good. So we can do that in part of our Cherries Jubilee. But we also made homemade maraschino cherries. And again, we're getting to the end of cherry season. If you want those recipes, don't be shy about asking. My guests today were Dan Weiner former chairman and chief executive at Advisor Investments, which is now RWA Wealth Partners, rwawealth.com. Mark Zajahowski, research analyst at North Star Inbound. The study was for bestmoney.com, and there's a direct link to it in our show notes. And Mark Fleming, the chief economist at First American. First American is online at firstam.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Woodrow Wilson, who said, "I use not only all the brains I have, but all I can borrow." Well, yeah, that's part of living the money life here. You are digging into the brain fluid and borrowing the brains of the experts. We want you to do it, but we want you to keep it in perspective. And remember, until we do it all again tomorrow, best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and stay calm. We'll see you here again on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Well, what are you waiting for? Somebody to kiss you goodbye?
Well, no, I guess not.